Real talk, you're working hard, saving what you can. Maybe you've got a 401k, maybe some index funds, maybe just cash sitting in a high-yield savings account. And somewhere in the back of your mind, there's this nagging feeling. Am I doing enough? Is this actually going to work? Here's why that feeling won't go away. Because right now, silently, invisibly, the biggest money transfer in modern history is happening. And almost nobody is talking about where it's actually going. Today, I'm pulling back the curtain. Why should you watch this video? Because the US government just made a decision that will reshape every major asset class for the next decade. They're not paying off the debt, they're weaponizing it. And if you understand how you can position yourself to win, if you don't, inflation quietly eats your savings while you sleep. My name is Moon. I obsess over where money moves and why it moves there. If you've ever felt like the system is rigged against regular people building wealth, subscribe. And if this hits different, leave a like. Let's go. Money. From where to where? Okay, first let me destroy a myth you probably believe right now. The US has too much debt. That's dangerous. Wrong framing, completely wrong. Here's the real number. US federal debt is $36 trillion. And yes, that's more than America's entire GDP of $28 trillion. But here's what nobody tells you. America is not trying to pay it off. Wait, isn't that insane? Nope. And here's why. Imagine your salary is $100,000 and you have $100,000 in debt. Debt to income ratio, 100%, rough. Now imagine your salary jumps to $200,000. Same debt. Now your ratio is 50%. You didn't pay off a single dollar. But you look and feel completely different financially. That's the exact play America is running right now. Don't shrink the debt, explode the denominator, and the tool they've chosen to do that? AI. Here's where the money is actually flowing right now. Microsoft, Amazon, Google, Meta, 4 companies, 1 year, $320 billion committed to AI infrastructure in 2025. That's $320 billion. In data centers, in chips, in power grids, in software. This isn't a trend. This is a government-backed industrial revolution. And here's the historical parallel that should give you chills. 1940s, the Manhattan Project. America went all in on nuclear technology. That single bet gave them military dominance for 70 years. AI is the Manhattan Project of 2025. The country that locks up the AI ecosystem first owns the next 50 years of economic power. America knows this, and they're spending accordingly. Who's moving this money? Here's where it gets really interesting. This looks like a private sector story, right? Big tech spending big money. No, this is a coordinated government strategy. Let me introduce you to one name you need to know. Kevin Warsh, Trump's pick for the next Fed chair. And he brought one specific idea to the table that changes everything. It's called the trimmed mean inflation measure. Plain English version. The Fed currently uses core PCE to track inflation. Right now it's running at 3%. At 3%, cutting rates looks reckless. The Fed can't do it without looking like they're losing control. But Warsh says, use a different formula. Strip out the extreme outliers on both ends. Run the same economy through that formula. Inflation reads 2.3%. Same economy. Different ruler. Totally different conclusion. At 2.3%, the Fed has a clean justification to start cutting rates. And here's why that matters to your money. Rate cuts leads to cheaper borrowing, leads to more AI investment, leads to productivity boom, leads to GDP explodes. The entire chain gets unlocked. People don't realize this is all connected. The US government wants AI dominance. AI dominance requires massive investment. Massive investment needs cheap money. Cheap money needs rate cuts. Rate cuts need an inflation justification. Kevin Warsh provides that justification. 1. Connected strategy. This is not a coincidence. Okay, buckle up. This is the piece that blew my mind when I first put it together. China is dumping US treasuries. As US-China tensions escalate, China has been offloading billions in treasury holdings, which creates a massive problem. The US needs buyers for its debt. China is walking away. Who fills that gap? Ready? Stablecoins. USDT, USDC, the dollar-pegged digital currencies. Here's the mechanism, and this is genuinely brilliant. Every stablecoin issuer must hold $1 of real reserves, usually US treasuries, for every $1 of coin they issue. So if the stablecoin market grows to $1 trillion, That's $1 trillion of automatic built-in demand for U.S. Treasuries. The market is currently at $230 billion and growing fast. And Congress is literally right now moving the Genius Act, legislation that gives stablecoins a legal framework, officially making them an extension of the dollar system. The moment that passes, institutions can flow in, banks can participate, the stablecoin market 10 times. And every dollar of that growth creates new demand for U.S. debt. China can dump all they want. Stablecoins absorb it. One sentence, AI wins America's industrial dominance. Stablecoins lock in its financial dominance. 2 moves, 1 endgame. Okay, I'm going to show you the whole picture in one shot. And I want you to actually feel this, not just see a chart, because every single arrow I'm about to walk you through, it's happening right now, today. It starts here. $36 trillion in U.S. federal debt. That's the fuel tank. And instead of draining it, America decided to weaponize it. The move? $320 billion into AI infrastructure in 1 year from 4 companies. This isn't corporate spending. This is the Manhattan Project. You build the ecosystem first, you own the next 50 years. Period. Now that $320 billion has to land somewhere physical. It lands on chips, GPUs, HBM memory, data centers, nvidia, TSMC, SK Hynix, AMD. The entire semiconductor food chain lights up. Here's where it splits, and this is the part that blew my mind. 2 things happen simultaneously. 1. The stablecoin market starts exploding. USDT, USDC. And here's the kicker, an XDC. Every dollar of stablecoin issued needs $1 of U.S. Treasuries backing it. So as the market grows from $230 billion toward $1 trillion, that's automatic built-in demand for U.S. debt. China dumps treasuries, stablecoins absorb it. Problem solved. 2. Kevin Warsh walks into the Fed with one number. Trimmed mean inflation, 2.3%. Not the official 3%. Same economy, different ruler. And at 2.3%, rate cuts are completely justified. Both sides feed into the same drain. Rate cuts begin. Cheap money floods the system. Borrowing costs drop. Investment accelerates. And then, this is the payoff. Asset prices rise. Across everything, bonds go up. TLT goes up. Semiconductor ETFs go up. Crypto goes up. The whole chain fires. Look at that flow one more time. Debt to AI, bet to chips explode to stablecoins, absorb the debt to Warsh cuts, rates to assets rise. 6 steps, 1 connected strategy. And the people who see this coming, they win. So where does your money go? 3 moves, clear and simple. 1. Semiconductors ride the AI infrastructure wave. $320 billion has to flow through something physical. That something is chips, specifically HBM high bandwidth memory. No AI data center runs without it. NVIDIA owns the GPU side. SK Hynix and Samsung supply 50% plus of the world's HBM. For U.S. investors, SOXX or SMH give you broad semiconductor exposure without picking individual winners. This is a 5 to 10 year infrastructure cycle. Short-term volatility is noise. Don't flinch. 2 long-duration bonds. The rate cut trade. When rate cuts hit, long bonds win. Here's the math. 10-year Treasury at 4.5% today. You put in $10,000. You earn $450 per year. Rates drop to 3%. New bonds only pay $300 per year. Your 4.5% bond, suddenly rare. Suddenly worth more. Your $10,000 becomes $11,500. Maybe $12,000. TLT iShares 20-plus year Treasury. ETF is the clean play here. Watch for Warsh's confirmation. Watch the 10-year yield. Those are your green lights. $3 denominated assets. Don't ignore the shift. Not telling you to ape into crypto. But here's what's real. If the Genius Act passes, stablecoins become officially part of the U.S. financial system. That's not a crypto story. That's a dollar expansion story. And if your portfolio is entirely in domestic assets with no dollar exposure, you're sitting outside the game while the rules are being rewritten. Start simple. Put 20 to 30% of new savings into dollar-denominated assets. That's your baseline hedge. Let me leave you with one idea. Everything America is doing right now. It's one move. Win by changing the rules. Debt too high? Grow GDP with AI ratio drops. Losing treasury buyers? Build stablecoin demand, new buyers appear. Can't justify rate cuts? Change how you measure inflation. Uncomfortable? It should be, because this system quietly rewards the people who see it, and just as quietly punishes the people who don't. 10 years from now, the gap between those two groups is going to be enormous. Every time the news says Fed holds rates or trade war uncertainty, you'll stop hearing noise and start seeing the machine underneath. That changes everything. If something clicked for you today, hit like. Seriously, 1 second means a lot. Not subscribed? Do it now. I dig into this stuff every week. I'm Moon. I'll see you in the next one.